relative to maybe where they should have been by that time period. We had observed that the global economy, particularly trade, this was pre the latest antics, was starting to slow down, and we were afraid it could seep into the US economy. Probably more important in my mind, we were in a meltdown in financial conditions. And since 1913, when the Fed had been founded, the Fed had never hiked with the decline we'd had in the S&P and other indexes going into that. Now, that was the primary reason. The editorial has been way overread and way overanalyzed. The last two words in it were "for now." The Fed shouldn't hike for now, take a pause, and just see how things develop. There's some background though, Scott. You're correct. Let me start from the very beginning. I will go to my grave, and often wrong, never in doubt, believing that really loose monetary policy greatly contributed to the financial crisis. There were obviously problems with regulation, but when we had a 1% Fed funds rate in 2003, after, to me, it was pretty obvious the economy had turned, and I think the economy was growing at 7 and 9% nominal in the fourth quarter of '03, and that wasn't enough for Fed. They had this little thing called considerable period on top of the 1% rate, just so we would make sure that their meaning was clear. And it was all wrapped around this concept of an insurance cut, the last one, an insurance policy. But the history of what I have seen, and I've made some money predicting boom bust cycles. It's what I do. Sometimes I'm right, sometimes I'm wrong. But every bust I had ever seen was preceded by an asset bubble, and generally set up by too loose policy. And the latest one at that time period that had just occurred was obviously Japan responding to our pleas in their own after the Plaza Accord, setting up the bubble in the second half of the 80s, and then we all know what happened in the 90s. So that's sort of the background I come at this with.
Well, Stan, so we can go to more recent history. This time last year, you got the Alexander Hamilton Award from the Manhattan Institute. And it
was really slim pickings, obviously.
Well, it was Nikki Haley was on the other side, so
I was on it for my looks. She was on it for substance.
They needed an opening act. But you said if I were trying to create a deflationary bust, I would do exactly what the world's central banks have been doing for the past 6, now 7 years. What did you mean by that?
Yeah, so I think Bernanke and the rest of the Fed did an unbelievable job once the bust occurred in '09. The QE was aggressive, it was decisive, interest rate policy, everything they did was spot on. But coming out of the crisis, and I loved QE1. Coming out of the crisis, QE2 I wasn't thrilled with. QE3 I was really disappointed with. And the reason was I was very fearful that the emergency days were over and the possibility was we were going to set up another misallocation of resources. The most recent one was obviously the one I referred to, which was the low interest rates, which created the housing bubble. So, I mean, 2012 came around, 2013, 2014, economy kept getting better and better and better. And every time I would give a talk like this, which was not very often, and everybody said, well, what would you do? Would you actually raise rates? I said, yeah, I would sneak one in every time financial conditions allowed. And hopefully by some point, rates will be high enough that we'll have an appropriate hurdle rate for investment where people won't be doing stupid things like they have in last asset bubbles. But as you know, Scott, we got all the way into 2014 and 15, and we're still doing QE3. And I was just afraid that people were going to start to do stupid things, and indeed they have. I'll just give you a few things that occurred since 2010. So corporate debt in 2010 was $6 trillion. It's now $10 trillion, so it's grown 65%. I don't know what anybody thinks about that. It's not necessarily a disaster. It depends on what they borrowed. But I would point out that during that same period, corporate profits grew from 1.7 trillion to 2.2 trillion. So that's cumulative over 8 years. So on a $4 trillion increase in debt, we got 500 billion in corporate profits, but it's worse than that. The interest cost on the extra 4 trillion in debt only went up 23%, from 475 to 565 billion. So think about the horrendous productivity of capital here. You increase your debt 65%, but your interest costs only go up 23%. You would think your profits would explode with that formula. They went up 29% over 8 years, not in 1 year. You know, they compounded with less than a 3 handle. You might ask, wait, corporate profits have been great. No, I'm talking about total corporate profits, not earnings per share, which is the other misallocation of resources. During that time period, 5.7 trillion buybacks, financial engineering, versus 2.2 trillion in capital expenditures. And if you go back to 2010, capital expenditures were 20%, buybacks were 20% of capital expenditures. They're now 55% with a much higher stock market. So you can sort of see where I'm going with this. You're getting a pretty gross buildup in the private sector. And by the way, if you look at it, the companies that are growing and innovating, they're not the ones who are borrowing the money. It's not Google or Facebook. They're spending their brains out on innovation. It's old, dying retail companies. Companies with, by the way, 24 square feet per capita in this country, and that number is 3 in Germany and 2 in China. But we have all these zombies walking around. So here we are in probably the most innovative, I would say, economic disruptive period since the late 1800s, and you hardly see any bankruptcies because there have been no market signals from the Fed. Now, this is pre the last year. We'll get into that. But there's one other problem with all this, and that's our government. Government responds to market signals too, and the clowns in Washington, unless they get a signal from the bond market, they're just going to keep spending. So for the first time in history, we have massive deficits at full employment. Estimates are this year there'll be $1 trillion. God help us if we get in a recession. If you just take the mean of what happens in a recession, that would go to $1.8 trillion. Debt to GDP has gone from 65 to 105, so you get the drift. So this is where we were going into this fall. I felt that Bernanke and Yellen in particular, there were so many opportunities to just put a quarter in while financial markets were booming, but fear of deflation prevented them from doing so. There's this belief at the Fed that if you're near the zero bound, you're near deflation, and that can cause, that's the boogeyman that we dealt with in the 1930s, the Japanese dealt with. But I've never seen a deflation happen because you were near the zero bound. Every one was preceded by an asset bubble. And we, to me, are creating a misallocation of resources and an asset bubble that could set up a deflation, and that's why I said what I did. Pretty long answer to a simple question.
So the Fed shouldn't be taking a victory lap. We've had malinvestment, no hurdle for capital. What are your thoughts on the new inflation target, and how did QE contribute to income or wealth inequality?
I just don't understand the 2% inflation obsession. We had 3% deflation in the late 1800s, and the economy grew at 8% real for 10 years. We had inflation of less than this level in the 1950s with the Fed funds at 4%, and we were just fine. It's very clear to me, but obviously not the Fed, and they got the PhDs, not me, that you need a hurdle rate for investment. And if you don't have a hurdle rate for investment, bad things happen. And there are periods when maybe a -1% inflation rate is appropriate. Other periods where it might be 3 or 4. It depends on what's going on. But we are in the middle, in my opinion, of one of the great productivity shocks in the last 150 years. I understand the government statistics don't show it, although we just had a very good quarter in productivity. But to me, it's immeasurable because our measurements haven't caught up with it yet. And by the way, I don't have the answer to the measurements. I just know they're not right. I'll just give you a couple of examples. 3.5 billion searches a day on Google. YouTube, in the last 60 days, has had more content uploaded on it, original content, than the entire television industry has done in the last 60 years. In 2010, we took 300 billion pictures. Last year, we took 2.5 trillion pictures. We took more pictures last year than since the beginning of civilization. The marginal cost of those pictures is 0. The quality with the phone in my pocket is better than it was with the best cameras 10 years ago. And in GDP accounting, okay, since you're not paying 50 cents to go and get your Kodak film processed, it actually subtracts from GDP accounting. Now, I understand they get some advertising, goes over here, but there's no way to measure this stuff. And I could go on and on. I think everybody in this room, there was a study out of MIT that you'd pay $18,000 a year to use Google search. I'd pay a lot more than that, $3,500 to use Google Maps. All this stuff is free, so it's mismeasured. Same thing with inflation, by the way. So why in the hell we're sitting here going, ugh, 1.4, 1.6, 1.7? We don't know what these numbers are. We don't know what GDP growth is. We don't know what inflation is. And we are in a productivity boom. So I'm not convinced that -1 or -2% deflation wouldn't be bad. What, we're all going to say, oh my God, I'm not going to buy something this month because Google is making my life cheaper?
If we've had a positive positive supply shock, then your view is low inflation and disinflation aren't bad. Is it possible the Fed...
But asset bubbles are. Go ahead.
Yeah. So the Fed is focused on the disinflation and the asset bubbles blowing up over here as a result. But is it possible they just missed the secular dynamic of platform companies and the sharing economy?
I guess so. I don't understand all this stuff. You know, R star, U star, Z star, they just look like, you know, with all this stuff going on, to be talking about that just sort of astonishes me. And it would probably be about 50th down on my list. I had a colleague, it was not Kevin Warsh, I swear on my children, who was at the Chicago Monetary Conference 2 weeks ago, or it was a week ago, it was a Friday. I said, how did it go? In the meantime, we've done all these tariffs, all this crazy stuff. Oh, it's the night of the tariff thing when Leha is going back to China, and the market's in a complete meltdown. And I said, how was the conference? He says, oh, they're really feeling much better about things and they're very comforted. And I said, why? Because Michigan inflation expectations 5 to 10 years out ticked up from 2.5 to 2.6. I'm like, seriously? This is what we're focused on in this country? And by the way, no kidding, these guys all have 30 IQ points on me, so I just don't get it. But go ahead.
Well, we just had one of the biggest 2-day moves in the history of the 2-year, so maybe they were focusing on the wrong thing.
Who knows?
So why don't we talk a little about your economic methodology? Stan always taught me the micro drives the macro. Can you explain what that means and how you use it?
Yeah, well, first of all, I was a dropout of the PhD program in Michigan, so we'll start with that. But when I got into business, it became clear to me that, well, macroeconomic statistics are not great in terms of predicting the economy. They're really great in terms of telling you where you are and where you've been, but in terms of predictive ability, they're not great. By far the best economic predictor I've ever met is the inside of the stock market. I don't mean the stock market, I mean the inside of the stock market. And that's looking at cyclical companies within the stock market. And I particularly like, because it tends to be the right kind of timing, trucking, retail, that kind of stuff, the Russell 2000. So if you just look at the periods I've analyzed, generally those stocks start going down and defensive stocks and secular growth stocks start going up on a relative basis.
So what's that telling us now?
Well, it's very clear. The XRT, the retail index, is down 24% since the high in August. I think the stock market's only down 7 or 8. It was 5 when I was preparing for this. The Russell 2000 is down 15% with a lot of breadth in that decay. The S&P metals is down 20%. And until today, which hopefully was some algo, otherwise I'm just dead wrong, which I am occasionally, it's been very clear all that stuff is at 52-week relative lows, and all the companies you would analyze that probably do about the same in a 1% nominal economy as a 3, they're all at relative highs.